Welcome to the Growing the Money podcast. My name is Rich Lennon. If you are an entrepreneur, maybe you're a real estate investor or a W 2 employee ready to accelerate your retirement plan, and you are ready to earn 30% without any banks, without any Wall Street, without having to wait decades to have access to those funds, then you are in the right place. Every podcast, we do simple, proven techniques to increase your cash flow, increase your wealth, and take control, most importantly, take control of your own financial future. All right, let's dive right in. I have a group. I have a group that meets every Tuesday, and I had some really good questions that came out of that group, some things that I don't normally address, some questions that maybe weren't in my educational content that I thought would be awesome to come out, answer those questions for everybody here today. And I'm just gonna go for it. All right. The first question I got, I thought was really good, and I don't really address this a lot, and so I thought it was appropriate to talk about. Is the question was someone in the group had an opportunity to lend money on a house, but the money that they were lending on the house was not going to go towards the improvement of the house. They wanted to use the money for something else, and that person wanted to discuss whether or not that was a good thing or a bad thing, and so we talked about it. And these are some of the these are some of the parameters that we kind of put around whether or not we should do this type of deal or not. My first thought, of course, was a lot of landlords, a lot of people who are building wealth, they will build to have free and clear homes. And so when they build those free and clear homes, they do it and keep them almost as a piggy bank where they will borrow money against that asset to go do something else. It could be like pay for a wedding. It could be go on an extravagant ski vacation. It could be I'm going to start a business, which is actually the most common of them that people come to me about. And the question was, do we approve of these types of loans? Because the money that we give does not go back to the house itself. And that was a really good question. The short answer is yeah, absolutely. A couple of factors. First of all, it's common for people who own free and clear properties, like I said, to borrow money for a period of time and then pay it back. And they kind of use those free and clears as a piggy bank throughout their life. It's a fairly common thing. It signifies a couple of things about your borrower. Your borrower has enough money and has been successful enough in life that they have a free and clear. Now, I'll say here that you need to make sure that free and clear is not their personal residence. This has to be an investment property. So even though we are lending it and they're not going to use it on the house, we go back to, as private money lenders, we only lend on non-owner occupied. But in this case, it was they wanted to borrow approximately $100,000 for the $300,000 asset, and they were trying to figure out if that was a good thing or not. The $100,000, not that it really matters, was going to be used to go start another business. And I suppose to the student that was listening or asking that question of, hey, that is a really solid investment, and your loan to value is right around 30%. You have a client who has had enough success in their life that they earn the money to have a free and clear. I might change my opinion a little bit if they didn't earn the money to have that free and clear. An example might be maybe they inherited the property from grandma and now they want to risk that property by starting a business, or they want to risk that property for the wedding. But in general, I think that this is a very secure investment, and your number one job as the lender is your money secure? And if your money is secure, then you can make the loan, and it shouldn't overly matter what they're going to do with their money. They've already proven to be good stewards of money because they have the free and clear property. I would never do this in second position, by the way. I don't really care how much equity is in it. To me, this is only a first position loan on a free and clear that I am totally fine lending on if they want to use the money for whatever. I will say I've done this a bunch of times. It really only breaks down into two conclusions. One conclusion is they borrow $100,000 and then they come back and they borrow $50,000, and then they borrow another $25,000 and they keep sinking money into whatever enterprise they're doing. And ultimately they have to go and they have to sell that property. So you as a lender have to manage that situation, but don't be shocked when they come back and ask for more money. The other way that this happens is they can go out, they can be really successful at their business enterprise, and they pay you off, maybe even in a quicker manner than you want to get the money back. Another question I got asked in that same meeting, and again, we always have that meeting on Tuesdays at noon. Another question I thought was really good was someone asked, should we be concerned if someone wants to keep our money longer than it was originally intended to give out? And, like any good attorney, and I'm not an attorney, but it will say it depends. And it depends on the security of the asset. If you are happy with the loan to value on the asset and someone is willing to continue to pay you, then I have no problem deploying my money for long periods of time. I've kept my money deployed as long as 2.5, actually 2 3/4 years at this point, and I'm very happy with that as I'm getting my money along the way, that I'm getting my interest along the way. The principal is in a very secure spot, and I'm happy to have somebody give me 365 days of return on the money. Now, it is important that, just one caveat here, it is important that you collect the interest in that situation along the way. You don't want to delay the interest payment. And the reason is because of the power of compounding. When you take the money and you're getting payments, you get those payments and then you reinvest those interest payments. So you're getting $2,000 a month and you're getting that along the way. And then it's 6 months and now you've got $12,000 and now you reinvest the $12,000. Now you're earning interest on the original transaction, but you're also now earning interest on the interest. And so I'm happy to leave my money out, but you have to make the interest payments to me because I need to compound my money. That's one of the huge factors of growth, is the power of compounding. So I am totally fine with someone keeping my money and moving it for a period of time. And you don't have to give that back as long as I'm secure and as long as I'm still taking advantage of the powers of compounding. Another question I got that led to a little bit of discussion on how substitution of trustee works is had someone that was generating a loan. They were trying to pick out who they wanted, what attorney that they wanted to use as the trustee, and they were really concerned about it. And I mentioned to them, hey, it doesn't really matter who you use as the trustee. It has to be an escrow. It has to be an attorney is the best option for being a trustee on a deed of trust. This is for a deed of trust state, not a mortgage state, but a deed of trust state. You need a trustee to hold the title until the loan is repaid. But what happens normally in these situations is at the first sign of foreclosure, the owner of the note does a substitution of trustee and makes the trustee an expert at the foreclosure process. Think about how this works in real life, like a retail buyer, just a mom and pop raising a family. They purchase a home and they're going to purchase that at an escrow company or an attorney of their choice. And that person will likely be the trustee on that note. And let's say that family unfortunately runs into hard times and the bank has to come back and foreclose on that home. The first document that the bank is going to file will be the substitution of trustee. The beneficiary of the note is allowed to change the trustee. And it's when you enter the idea of a foreclosure process that you, the beneficiary, can approach an attorney. You're going to have to put down a deposit, I'm sure, and then you're going to have to ask them to carry forward with a foreclosure process. But no matter who you choose as your trustee, when you originate your private money loan, keep in mind that if it actually does go bad and you actually do need to foreclose on the property, that you can use the substitution of trustee to change the attorney that's the trustee there to somebody, an attorney who is an expert at the foreclosure process. And that's how it happens in the wild. All right, that's it for today. My name is Rich Lennon again. If you're interested in figuring out how to move your money at 30%, whether you be an entrepreneur, real estate investor, look me up online. My name, it's richlennon.com. Schedule a growth call. I will sit down with you. I'll kind of go over where you are, what you're trying to accomplish. Maybe I could give you some suggestions on ways that you could build that. And if you're interested in our group, you could certainly schedule a growth call and talk to me about that. All right, everybody have a great day, and I will see you soon.